call the meeting to order. We need sorry, we need a motion to adopt the agenda for today.
So moved.
Moved and seconded. All those in favor indicate by saying aye.
Aye.
We also need a motion.
Aye.
All right, you guys. We also need a motion to approve the minutes from August 5th if you had a chance to review them.
So moved.
It's been moved and seconded. All those in favor indicate by saying aye.
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 Chair votes aye as well. All right. Well, this is an opportunity for the public to comment on any public matter that is not on the agenda of the meeting and is within the jurisdiction of the Teachers Retirement Board. However, the board may not take action on any issues raised unless it is included on the agenda and public comment has been allowed. If issues are raised that would require board action, the issue would need to be included on the agenda for a future meeting. Public matter does not include disability applications or contested cases and other adjudicative proceedings. Just a small amount of public. I'm not sure. Would you like to introduce yourself? I'm not sure behind the cabinet.
Rebecca Power from Legislative Services. I staff the SABA committee.
Okay, thank you so much.
Looks like Sarah's online.
Oh, okay.
Sarah. Right.
Sarah Piper's online. Okay. Thank you. All right, well, we're ready for our actuarial evaluation.
We're ready to do
Todd Green and Brian, is it Hogue?
Hoagie.
Hoagie.
Like the
Okay.
sandwich.
Hoagie sandwich, all right. I wasn't sure.
I'm hungry. So we're here to present the results of the July 1, 2022 actual evaluation. The first one I did was 2009, so time's flying by. So if we go to the first page of our presentation, I always start off with this. Basically, it's just an education piece, which I think summarizes what we do, and it's a good reminder for everybody. But on the left-hand side of this equation, well, first of all, it's called the basic retirement funding equation. And on the left-hand side represents the money or investments and contribution side, and the right hand is your benefit obligation for all the participants. What we do as the actuary is we estimate the long-term benefit obligation of the plan. So, if a brand new teacher gets hired, we have to estimate how long they're going to work and are they going to make it to retirement. Once they do make it to retirement, when do they actually retire? They retire immediately, or do they wait a little bit after first becoming eligible? We project out their salaries. From there, we estimate an actual retirement benefit, and then after that, the question is how long are they going to live to receive it, essentially. So we make a lot of assumptions along the way, and from there we do that for every person in the plan, and then we come up with the liability for the plan, and then we essentially determine here. In some systems, we actually determine a contribution, but here we determine if the contribution is sufficient to fund the plan because they're all set in statute. So the other thing to point out here is that roughly, and this changes depending on how the market's doing at the time, but about 60 to 70% that gets paid out from that right-hand side actually comes from investment income. And so that also highlights the advantage of having a pre-funded retirement system. So like yourselves. If you think of Social Security, which is not pre-funded, you only have contributions and benefits. So if the contributions from payroll taxes aren't sufficient to support the current benefit obligation, then you have to either increase contributions or reduce benefits. And that has to happen immediately because there's no, they can't really rely on a pool of assets to pull money out of. So this next slide here, just a couple, you can go back there. Yeah, thank you. So just, in the long term, the cost for the plan really depends on the other elements of the equation, but in the short term, the costs really depend on the actuarial assumptions. So we can't wait 100 years to figure out what the plan costs. We got to figure out, or try to figure out today what we think the plan is going to cost. So in the short term, costs are really dependent on the assumptions, but in the long term, it's really just a balancing item from all the other pieces. And then as far as the benefits are concerned, they're really driven by the plan provisions themselves. So, the eligibility conditions for all the different benefits, and then the experience of the plan, are people, when are people retiring, how long they're living, that type of thing. So we'll go to the next slide. So since the previous valuation, as you know, we were here in the spring, we presented an actual experience study and we updated some assumptions. And it first became effective in this valuation. So it increased the unfunded liability by $78.2 million, which is pretty close to what we estimated based on last year's valuation. It did reduce the funded ratio by 0.85%, so a slight reduction in the funded ratio. And it increased the amortization period by 3 years. Some of the key assumptions that we changed were lowering the discount rate from 7.5% to 7.3%, increased the inflation assumption up to 275, and then we updated the mortality tables, retirement decrements, termination rates. And, you already sat through that one, so it's just, but just to highlight the significant changes. So the next slide here, the assets for the year on a market value basis had a negative 4.13% rate of return, which, believe it or not, is not as bad as some other systems out there. You guys, are pretty decent compared to some others I've seen. And just to point out here too, we did change the assumption to 7.3, but that's forward looking. So we still have this one, we're looking at the period from 21 to 22. So that's why we're still comparing it to 7.5%. On an actuarial basis, we actually had a gain. So, and this is where on the actuarial basis, we smooth our gains or losses over a 4-year period. And so what that does is it allows you to bank some gains and some losses, and hopefully they offset essentially. And what this does is just reduce volatility in your required, or in your case, your amortization period, essentially. But the thing to point out here, though, is now your market value of assets are less than your actuarial value. So that means that you have basically an unrecognized losses that are in the smoothing process right now. And these will be recognized over the next 3 years. You'll see that we actually have 2 years of some small gains and then a final year of that significant loss. And the reason why we have the 2 gain years is because last year's performance was so good, we're still using some of that. So once that finally drops off, you get the $146 million hit there. So, and this is based on if all assumptions are met. And, it's been a tough year so far, starting out since June. So, so at this point, if you can hit the 7.3% every year, this will happen. But, we know that that doesn't happen in reality. It's either above or below. The next slide,
Can I ask a quick question?
Sure.
Down at the bottom, it says amortization period increased from 24 years to 25 years. Is that number the primary catalyst that would indicate that a change has to be made to either the contributions or the benefits? And if so, at what number of actuarial years would that indicate a change?
Well, it would be one key factor, but not the only factor. Right. So you'd want to look at funded ratio and all these those things together, essentially. So
if we keep it to amortization period, how many numbers of years would send up a red flag to begin to change the?
Well, I mean, over 30 sends up a red flag statutorily for you, right? Because then you have to introduce a funding bill. But that 30-year amortization, that's no longer really a best practice, so more, you want to be more in line in like the low 20s, 20, 25 years, that's kind of where you'd like to live. But you would, in an ideal world, you'd also want to set up a contribution policy that would actually pay that off. Where here, the contribution is set in statute And so, and the benefits are the benefits, and so that's the liability side. So, that's really your only, that's the only thing that can float in this calculation. So, yeah, I mean, if it's at 30, yeah, that would be, you know, you'd want to monitor it, but keep in mind, if all the assumptions are met, that this should decline, you know, systematically every year. Yes. Yeah. So, but in a perfect world where you had, you know, and I brought this up before, layered amortization methodologies where, you know, an actuarial determined contributions, we probably wouldn't want to live at 30, right? We probably want to be, you know, down at 20, you know, so.
Thanks. I recall that from a previous conversation, but just wanted to verify it.
Yeah, so that's a good question. And then you'll see here the funding ratio. The funding ratio for the plan increased from 71.43% to 71.73. It's pretty modest. Even though we implemented the experience study, the funding ratio still improved from last year. And then finally, this is every other year we do this measurement of the MUS supplemental contribution. And as you know, that's the current statutory rate is 4.72%. So that comes in off the MUS payroll that goes into the plan. And the purpose of this is to help pay off the unfunded liability for the university members or university system members who are members of TRS. So basically that rate as of July 1, 22 is it should be 13.53% to make sure it gets paid off by 2033. So that's an 8.81% shortfall on that current rate to the 472. The 472 has never changed as long as I've been here. So, and I think it increased maybe the year before we were hired initially. So, if they wanted to maintain the same payment schedule to pay off that unfunded by 2033, they could also leave it at 472, but put in $207.6 million into the plan. So
Just period, or not every year?
no, just
Okay.
one
All right,
time,
thank you.
yeah, and then still put in. They'd still have to do the 472 after that, but yeah. So again, that's part of our obligation to you is to fulfill this calculation, and
This is factored into the information we looked at on the previous page, correct?
yes, it is the 472.
So is there a way to say, if they were to cover this unfunded liability in total, how many years that would knock off of our funding?
There is. I couldn't do it
Yeah.
off the top of my head, but I can.
Oh, come
I can
on.
get back to you.
I'm just curious. You don't need to
So-
do the extra work.
Well, actually,
Yeah.
we'll have that as part of the fiscal note for our university system supplemental bill.
Okay.
That shows up.
Yeah.
It changes the amortization period. And I think last session, I want to say it dropped like 4 years off. That's pretty significant.
Yeah, no, it's, yeah, I mean, that, you know, that the university system's payroll is a significant number. So if you can get 13.53% of that, that's, you know, that would be a big help to the, you know, and it would basically eliminate $300 million of unfunded liability. You know, that would be the purpose of it. So,
Yeah.
So with that, I'm gonna turn it over to Brian to take us home.
Yeah, so Todd kind of went over the high level stuff. We'll get into a little bit more of the details with evaluation results. So first off, it always starts with the data, right? That's the membership drives our liabilities. So we'll kind of walk through what we have with this valuation. So on slide 9 here, take a look at the active and the retiree populations, or the active and the members that are currently in pay receiving benefits just over the last 14 years, kind of see a trend where, or what we've seen. For the active population, we actually increased 1.6% from last year's active membership. The assumption is really that the active population stays steady, but actually an increasing population is good for the system. It's kind of lifeblood. You're bringing in contributions on that pay. So it's good to see that the active membership has increased. And then as expected, the number of in-pay members continue to increase as well. As people retire, they continue to increase that number of people that are receiving benefits. So just under 20,000 active members, and then a little over 17,000 members that we're currently paying benefits for. Okay. And then if we go to the next slide, what we're paying these members. So the average salary the light blue bar for the active membership. And that increased a little under 3% from last year, and about 1.6% annual increase over this period that we're showing overall. And then the increase in the benefits about 1.5% as well. So average pay a little over 58,000 for the active members, and the average benefits, the annual benefits that we're paying out is a little under 25,000 on average for an in-pay member. So again, as expected, these are kind of increasing throughout the period.
Brian?
Yes.
I noticed that from 2008 to 2022, the number of actives increased by approximately 9%, which is, it seems to me, somewhat commensurate with the population change in Montana during that same period. The retirees, of course, have increased by a whopping, like 50%. So what is driving that, and do you expect that demographic trend to continue, or do you think that ratio will go back down eventually?
I don't know that it would ever go back down to what we saw there. With an open ongoing plan, you generally see the number of retirees increasing, especially with members living longer. We don't have as many people coming off the rolls as we have retiring and coming on. And as we see more active members come in, they're going to have a bigger population to be able to retire and eventually receive benefits. Down the road, this in theory, right, you should get to a ratio that's pretty stable, but it's not uncommon to see this increasing ratio.
And that's a theoretical ratio too. It's
Yeah.
like, if you do projections, you kind of see it, with fake people essentially. But the other thing to point out here too is this is part of our valuation process, is actually estimating that retiree liability or retiree benefit amounts, on that, based on each active population as we go. So that's not a surprise to us, because that's the B side of the equation that we're making all the assumptions about. So that's anticipated. Actives, we don't assume new, our valuations are closed, so we don't assume new actives every time we do one. So it's not until the following year that we know, oh, there's some new guys now, that came in. So each valuation is a closed system, essentially.
Okay. Thanks.
Slide 11. Just looking at the total payroll and total benefits for these members. So total payroll, a little over 800 million for this valuation, and that's up about 2.5% from last year. We have an assumption valuation, that payroll growth assumption is 3.25%. So we expect the total payroll to grow at that rate. If it's below that, it actually puts a little bit of pressure on the amortization period, because we're not getting as much in its dollars of contributions as we would expect if that payroll had increased 3.25%. And so that does help put a little pressure on the amortization period. Conversely, if we would have the payroll grow more than 3.25%, that helps the amortization period shorten a little bit as we're bringing in more contributions than expected. So that's kind of a nice one to look at, the trend with the payroll, and then the benefits as well, just kind of how much we're paying out in benefits per year. So about 430 million this past year in benefits. So that's kind of the active membership, how it drives our liabilities. The other half of that equation is the assets, right? We need to compare the assets to our liabilities. And so what have our assets done? And again, looking at the past 14 years, this graph here shows the actuarial value and the market value of assets. The blue bars are the market value. And because we use the asset smoothing method, you will see these two numbers not equal, right? So sometimes the actuarial value is going to be higher, sometimes the market value is going to be higher, and that's what we would expect. So in last year's valuation, 2021, we actually had the market value higher than the actuarial value, to where we had some unrecognized or deferred gains, right, to help with that smoothing. And that's what Todd pointed out, why we had that actuarial gain on the actuarial value of asset side. So even though we had a 4.1% decrease in the market value, we still had that over 8% return on the actuarial value. Problem is, now that we have the actuarial value higher than the market value, so now we have those deferred losses or unrecognized losses that will need to flow through and put some pressure on that amortization period and funded ratio of things. So, next slide. And we have the assets and liabilities to look at our funding results. So we'll give you three columns here. The first column is last year's valuation results, the July 1, 2021 valuation. Second column is the current year's valuation, but before the assumption changes were implemented. And then the far right column is with reflecting the experience study or the new assumption changes. So the first line here is that total normal cost. And if you remember, that's the ongoing cost of the plan. The active number is kind of what we need to pay to contribute to make sure that we're funding their benefits. And that actually increased 1.2% from the prior year, mostly due to the assumption changes, the decreasing assumed rate of return, changing the demographic assumptions. So that drive that up. Member contributions stayed the same at 8.15. And basically it flows down to say that we have 9.14% available to amortize our unfunded liability, how we're going to fund that debt. And this is the amount that we have. Total employer contributions, 11.86. That did increase by the 10 basis points as expected. And I think we have one more increase on that next year. So the bottom line, kind of last two rows here, Todd mentioned our funded ratio did go up a little bit from last year. Without the experience study, we would have been about 1% higher as expected. And then the amortization period went from 24 up to 25. Again, without the changes, we would have been at the 22 years. And again, that's what was expected with the experience study, that three-year increase to the new assumptions.
Yeah, just to point out, there's also 25 million a year that comes into the plan as well, from the state, that the state puts in. So in addition to the 9.14%.
So Brian, quick question here. So to amortize. So this 9.14%, if we were fully funded, that would be enough to keep us fully funded. But since we're not, we have the extra 2.5% to try to pay down. Or am I looking at the numbers wrong?
What was your 2.5?
Well, the difference between 9.14 and 11.86.
So if you were fully funded,
How much would we need?
well, in technically zero, but you would still get it. I'm sure the legislature would probably try to change the law to get,
Okay,
but you're getting 9.14% regardless.
so
Because
the
that's the
normal
way-
cost is what we would need to cover
The ongoing
the
benefits.
ongoing benefits.
For the active members, yes.
Okay.
So the plan would only cost 2.72% of pay if you're fully funded. But you would, in theory, continue to get 9% of pay as well. So it goes down by 1 because the member dropped down 1%. So there's some things that switch,
That's right.
when you become better funded too.
Well,
So
the cost of living adjustments would go up too, so you have some
yes.
changes there too.
Yeah.
Okay.
Slide 14. The last slide with the valve, just kind of look at what happened from last year to this year. So we call them actuarial gains and losses, or things that happen different than expected based on our assumptions. So first one, not really a loss, but it was expected with the change in assumptions and methods, and that increased by the 78 million that we talked about. Really all the other ones, mortality, withdrawal, disability, some data adjustments, investment income, all those added up really to just a $10 million gain. So in the grand scheme of things, with as much liability in the plan, pretty small. But we did, just kind of breaks it out. Like, so when you see losses like with retirements and things like that, the green bar, that's just people retiring earlier than expected, causing actuarial losses. And then gains, again, the investment gain was on the actual or the smooth value of assets. So it just kind of breaks it down on what we saw over the last year.
Another quick question on that. It's such a small portion of the total expenses, disability retirements shouldn't concern us too much, I suppose, but I'm just curious, over the years, have you made any evaluations as to the percentage of teachers that have retired in a disabled way, changing from year to year or from period to
So
period?
we reviewed that during the experience study.
Okay,
And like, as you pointed out here, we're seeing very little experience, but
right.
you don't want to get rid of it because when they do happen, it's, disabilities are costly. So it's one of those things that we're anticipating, but still seeing very little experience in that regard. So.
Yeah, and with the experience study, kind of because there are so few of them in the grand scheme of things, with people becoming, or teachers becoming disabled, we did look at the last 2 experience studies. And if you took those, I think it was eight years of information that we had, or 8 years of data, it was pretty close to the assumed. So we didn't make any changes to that assumption. But again, you're gonna see some spikes in between. It's not always gonna be exactly what we expected, but
Sure.
overall it's been.
With the limitation of experience, it's hard to get a lot of data, but
Right.
I guess what I was wondering about is if there's certain geographical places that may indicate a higher level of disability due to, I don't know, mold, or I was just wondering about, for example, Butte, and whether or not the mine has caused more disabilities over the years, but we don't have that much experience to know.
That's right. And yeah, we examine it in total. We don't have the breakdown of where people are working in the data that we have. So,
Right.
But I don't know if that would provide any more clarity to,
I mean,
does
it
that make
probably wouldn't
sense?
help to
It
know.
wouldn't help at all. Yeah,
Yeah,
it's just so small. So.
yeah, okay, thank you.
All right, so that's kind of the evaluation results. There's one other thing we wanted to bring to your attention, I guess, just kind of so it's not a surprise with next year. So as actuaries, credentialed actuaries, we have to follow these actuarial standards of practice. There's about 60 of them. And there's one that's new, or not new, but it's been changed. It's been worked on over the last 10 years and will actually come into effect next February. So with the next valuation, the June or the July 1, 2023 valuation will be effective for TRS. And there's a few things in this standard of practice that will really be new. We're going to touch on a couple of them. So one of them is this low default risk obligation measure. It's a mouthful, but LD-ROM. We'll talk about that in a second. And then we need to disclose a reasonable actuarially determined contribution. This is new as well in there. We'll touch on that. A few other things like they say you need to describe or talk about the funding policy. Their fancy word for it is the contribution allocation procedure. And then there's a few other changes that either don't affect teachers or we're already doing. So just wanted to kind of put this out there. So the first one, to go to the next slide, this LD-ROM. So what it is essentially we need to come up with a liability measure. So right now we have a liability measure based on a 7.3% discount rate, what we're assuming we're going to earn in the future. Now what they're requiring is to have a new discount rate that's based off of low default risk, or essentially a risk-free rate. So it's going to be lower than that 7.3%. And if you go back to Todd's first couple slides, that C plus I equals B plus E, if that I piece, if we're not earning 7.3 and we're earning something lower, contributions go up. Contributions don't change, that extends the amortization period, right? And so it's going to be a liability number that's much higher than what we have now. I've seen some other ones that we've run some numbers on and potentially doubling the liability. So depending on where
so your accrued liability right now is 6.7 billion.
we might be 10 to
It
12.
could be at 12, at this measure, basically.
So the thing here that we're a little bit worried about is people taking this that don't want DB plans open, saying this is now the new true cost of the plan, even though it's not. So we're going to have a little bit of work on our end to do some communication, right? Get this number across for what we think it is. And really the way we would interpret it is that difference in liability, if we go up to 10 billion, we're saying this is what the plan is actually saving by prudently investing or having a good investment policy, because we can earn the difference here. This is how much we're saving
You're
because
saving
of this
taxpayers' money, basically.
Absolutely.
by investing prudently.
Yeah.
So again, there's probably going to be some people that take it differently. We weren't in favor of having this on there, but there's a number of different actuaries, like your life insurance, your property casualty, your corporate pension actuaries. The public sector is pretty small, and so we kind of got steamrolled and ended up getting this put in there. So you don't have to do anything. We just have to disclose it. We don't have to say this is what the amortization period would be with this. We don't have to disclose the funded ratio or anything like that, but it is going to be a disclosure that has to be in the report. And so we just want to bring
Is
it.
that based on a treasury rate, and so what maturity?
Right. So there's they don't give us specific guidelines, or specific requirements. They kind of say guidelines. And one of the things in there was like 30-year treasuries matching your benefit
Oh,
payments.
okay.
So like we're going to pay out benefits for all these members over the future. And so what they're saying is essentially we're going to have to like duration match with treasuries or something similar to that.
It's like almost creating your own yield curve,
Right.
essentially. So,
So again, there's no set in stone, but that was one of the examples that they provided in the guidance. So,
Did we have to do something similar for the legislature? Didn't they ask us to do something like that?
They have, we ran, even ourselves, we ran the stress testing, and then the legislatures asked us to run scenarios where, you have a much lower rate of return assumption. I mean, I've participated for years in different surveys that Pew does and Moody's and some of them, and they'll actually take all of our numbers and convert it using a much lower discount rate as well. So it's really, it's going to be a new number that's in our valuation. And, I just asked Todd if he could touch on it, because next year will be the first time you actually see it. And we don't want you to be alarmed by it. It's everyone's going to be in the same boat. The GASB 67, 68 calculations for a lot of plans, if they hit the crossover point, then they have to use a really low discount rate as well. And so some plans have those numbers in their annual reports at this point on the financial side.
Which entity is it that's requiring this information in the report?
so it's the Society of Actuaries, or the actuarial community. We're really a self-governed profession.
Okay.
So because we self-govern, we have all these standards of practice that we need to follow to be a part of the organizations. And so it's the actuarial community that's now requiring this as one of our standards of practice to include.
So are you capable in the report of putting in language that would describe what that event is really trying to say, which is essentially a worst case scenario?
Yeah, and I think that's what
gonna,
we'll
yeah,
look
and
to
that's
do.
gonna be our approach.
Yes.
Is we're gonna try to put a positive spin on it as possible. So,
Yeah, it definitely won't be in big bold letters on the first page.
yeah,
Like,
we're not gonna say, oh, we just did this valuation, and by the way, it's meaningless because this is the real number. Yeah, it's not gonna be like that. So, no, it's gonna be a more positive, look at it. I mean, to me, it's the money you're saving by investing, right? You're
Right.
saving taxpayers' money by doing that. So, that's how I look at it.
Is there politics involved in this, or is it just a mathematical standard?
It's just actuaries, actuaries love numbers, and it's
It's
like,
called cover your backside.
Yeah, I get it.
yeah, it's actuaries just love numbers, and there's actuaries who work in our profession who serve clients, similar to you, who would love this stuff, and if they could produce another number. We feel like the less numbers, the better, right? You want to be clear, concise, to the point, so all the users understand what you're looking at. But now, by introducing something like this, it's just going to create confusion, so.
Well, I think it does bring out an opportunity to talk about the value of what we do.
Exactly.
And we when we were at the trustee workshop this summer, we heard all kinds of downsides to all of this, but the reality is, I think it's probably more positive than it is negative. Because it does actually illuminate pretty much in bold print that you're doing much better by managing your investments prudently than if you just assumed treasury.
Absolutely.
And there's no market for that too. Like if you wanted to go and buy, you could not probably, you wouldn't be able to buy if all retirement systems decided to go to the market that one day to go buy treasury. I mean, it wouldn't be, I don't think you could do it. Like
No,
there's not enough out there. So
It's kind of a non-real.
Exactly.
it's like not a real exercise in reality. So.
Thank you.
Yeah, well, there's one last slide here, and I think that this, to me, this is probably the more important one, and it could impact you guys, and it's only because you have this fixed statutory contribution. is that, we have to determine if your contribution is, adequate, right? And so, at longer amortization periods, it may not, and we would be required to, again, produce another number, like maybe, using a layered amortization approach, right, that we've discussed before, or something like that, because, when you have longer amortization periods and you're using that payroll growth assumption, it does create some negative amortization. And one of the things is that you can't have excessive negative amortization. So we would have to comment on that as well in the report. So, but it doesn't require you guys to make any changes or anything. This is really just something that we have to do, but you're not required to follow it at all.
So to Dan's earlier question, if we got to 26, you guys would have to put in a disclosure to say, yeah, it should be 20 to 25. I mean, is that the new standard?
Yeah, I mean, yes, right. So we would say that your amortization period is too long, or that for that long of an amortization period, we say we need a lower payroll growth assumption, for instance, which, basically, but the problem is it's like two things, you lower your payroll growth assumption, that's going to extend your amortization period, right? So it doesn't magically, but and that would work in the real world if you contributed actuarial determined contributions, because then your contribution rate would adjust accordingly.
Okay, now you have me a little bit confused.
Yeah.
Because if payroll goes up, we've got more contributions coming in.
Right, but the standard says you can't have excessive negative amortization. So if you're using 3.25, if you higher payroll growth assumptions means that you don't start paying principal right away.
Right.
And that's what they're saying, they really say that your funding policy should at least cover the interest on your debt, essentially.
Right.
And so at certain if your amortization period is long enough, then it's not doing it the first few years, right? So that's where we would have to, comment, and we actually already do in the report.
It's there.
It's in there. So, but it would just have to be more specific, because I think we'd have to actually put in an alternative, where right now we just explain it and leave it at that. So.
Todd, I'm going to interrupt you for just a moment. Dee has her hand raised and we just noticed that. So
Thank
Dee, would you
thank
like
you,
to?
Chairman. I just have some observations. If the actuarial standards of practice have precipitated some changes in the future, I'm wondering, is it because of some bad actors? I mean, why would they do that? And second of all, the faster we can get the education to the legislature, because I can guarantee this is going to be fuel to fodder. We need to start educating our legislative bodies so that they don't come to some weird conclusions, if you will.
Agreed.
Good point.
Can I
Yeah.
respond to that?
Yes,
So,
please.
so right now, the NCTR and NASRA and what's the other one? NCPERS are working together right now to create, and we're actually participating in this to create a like a communication piece to help help explain it. But so that is being done from those organizations side right now, and that will help with that. So I think that'll you could use that.
Yeah, and then if I guess my response to that too, D, would be that the timing of it will actually be better for us. I mean, it won't be a factor during this next legislative session because that number is not available, but it will come out in the middle of the next interim. So we'll have a pretty good opportunity over that interim to discuss that and educate the SABA committee as well as LFC.
Thank you.
Good point, though. Thank you.
Very good.
Sorry we didn't see your hand.
No, that's fine.
It's little.
It's tiny. It's a little tiny.
On the screen, yeah.
Yeah. Go ahead.
Yeah, that's really what we had. Again, these new standards don't force you to do anything. They force us as credential actuaries to. We need to disclose it, but again, it doesn't implicate you. There'll be more information in the report, but again, it doesn't drive your decision making. So again, that's what we had when we put that out there, so you're not surprised next year.
Well, basically what I got out of all of this is over the next 25 years, the difference between what we've been doing in the past versus what could be done if we had to be forced to go to treasuries, we're worth about $60 billion.
So yeah, so that concludes our presentation. So if there's any questions, continue to take questions, or that's it.
Board members have any questions? Sarah or Dee as well? I know Dee, your hand is still raised, so I'm not sure if you do still, but, or Sarah or any of us.
No,
No,
I'm
I
good.
just-
Oh, sorry. Go ahead.
I forgot to unraise it.
Okay, good. Sarah, did you have any questions?
I just had a comment. I just want to say that the workshop in Berkeley over the summer has helped me tremendously understand a little bit more about this process. So no, yep, I'm good.
Excellent.
And I was gonna make the same comment. Those workshops are cool.
Can get better education. All right, well, thank you guys so much for coming to us, and always
Good to see you.
Yeah.
we would like better news next time. Would you get us a huge
Stop the Ukraine war or something.
Yeah, right. Produce my
gas
chips,
prices,
right?
everything,
Yeah, microchips,
inflation? Would you just
yeah.
help us with everything? Yeah. All right, this is also an opportunity for public comment. If you have anything you would like to add, or I see that you're the only public, but also Sarah, you are here, Sarah Piper. If you would like to comment. All right.
Yeah,
Oh, she does
I
that.
raised
Okay.
my, sorry, I raised my hand, but I'm not really sure what the protocol is for this. I apologize for not being there
Good talk.
today in person. Sarah Piper with Montana Federation of Public Employees. And I just wanted to express my appreciation for the clear presentation we just received, especially the preloading of the information about the changes that the actuarial standards will be bringing forth. I think that the point that the gentleman made from Kavanaugh McDonald about actuaries love numbers, and there's a lot of actuaries driving some of these standards who don't work on pensions, is just very important to remember that they're looking at this from insurance and all sorts of other industries as well. And best practices are best practices, but I couldn't agree more with Board Member Brown's point that we do need to make sure that we are all working to educate our members. And I appreciate learning more myself so that I'm better prepared to have those conversations with participants in the plan that are part of our organization. So thank you all very much for the work you're doing on this.
Thank you, Sarah. All right, well, we need a motion to adopt the July 2022 actuarial valuation results.
So move. Second.
It's been moved and seconded. Is there any further comments or anything about our valuation? Seeing none, all those in favor of the approving or adopting the July 1st, 2022 actuarial valuation results indicate by saying aye.
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 Votes aye as well, or any nays? Nope. So we're good. That motion passes. All right, and we are, and thank you again. We are on to administrative business. And Daniel, we're talking about your investment report.
All right, this will be fun.
We've been waiting. for
Yours,
it.
all yours.
I know, I missed one of these. So I guess I'll just start off with the numbers here. I think if you look at page 1 under the tab on the investment report here, we've got the 1-year number showing there at a minus 5.11%. I think, Dan, I don't know if you can comment on this too, but I think anyone who's an investor right now would be very pleased with that number.
Given the fact that the Dow, I mean, they're not quite the same because that's a fiscal year from July to July.
Right.
The indexes, all three of them are down substantively more than that. So
Yeah,
yes,
down
I think that's
20%.
actually a success.
Yeah, so it's not fun to see, but these guys are doing a really good job. A small caveat to that, we've got 20-some% of our investments in private equity, private real estate, and those reprice on a different schedule. It could be that things turn around quickly enough that those stay up. It also could be the fact that these issues we're having drag on long enough that those start to reprice down too. So there's a little bit potentially of some losses in those areas that aren't really being reflected here just because we don't get to see those valuations very often. Yeah, but in terms of significant changes to asset allocations and things, there really haven't been anything big. I know they're a little bit hesitant to do a hard rebalance here. And probably a little bit because of what I just said about how repricing is a little bit slow on those private assets. And those private assets aren't that easy to sell. But if you looked specifically at the allocation today and said, hey, we need to be at the midpoints on everything, we would be selling private assets right now. And we're sort of hesitant to do that. I don't think they're going to do that. They're going to hold off for a little bit and see how things shake out a little bit. So interest rates are higher now. That hurts the bonds you already own, but it helps the bonds you don't own yet. So in the long run, that's actually a good thing. And nobody knows what's going to happen with the economy. I would say this was echoed, I think. We had a couple of different folks talk about where they think things are headed. Probably a recession. The definition of that historically has been a couple of quarters of negative GDP. We probably already are having that, but in reality, the definition includes more than that. It includes higher unemployment, a big decline in corporate earnings. We haven't seen those two yet. So I don't think we're technically in one. And the Bureau of Economic Statistics gets to make that call. Usually by the time they make the call, we're already out of it because they look at data going back quite a ways. So we'll see how that shakes out. If it is a recession, at some point, it's probably going to be mild because getting to high unemployment from here is a stretch. I just think we're still sitting at 2 job openings for every unemployed worker. So the idea that we're going to be in a situation where people can't find jobs and they can't spend is remote, I think. So probably a minor recession. Markets maybe were a little bit too high coming into this. This part of this is warranted, especially in tech. And the way that our money is invested is more conservative, more value oriented anyway. So that's another reason why we've done a little bit better. From an administrative standpoint, I just would say I'm really impressed with the staff and the board and everybody over there. We got our money in good hands. These guys know what they're doing and they're doing a really good job. We had a resignation here recently, one of our department or I guess asset group heads. And it looks like we're gonna, I don't know if it's public or not. So I guess I can't say who we're hiring, but looks like we got somebody to hire for that. So that should be good. Is that public? John, no?
Not that I've heard.
Okay, sorry. The other couple of things we've talked about, there's some discussions afoot about whether BlackRock is a good provider. And it's a little bit political, it seems. I guess my opinion on that, and I think the opinion of the rest of the board is we're going to go to the provider that provides us the best value for the lowest cost. We have a fiduciary responsibility to do that. So if there are reasons why people don't like BlackRock or the folks that run BlackRock, we can sure look at alternatives. We can look at Vanguard. We can look at a few other places, but I don't think I think BlackRock charges us 3 basis points and they manage like 25%. It's just indexes. And if those indexes have companies or things that people don't agree with, it's an index. We're not picking anything. We're just trying to be as efficient as possible with our money. We'll see how that shakes out, but I think that's our stance. We can sure get quotes from other folks, but it sounds like anybody else would be double that, probably, if not more. There was some concern about how BlackRock might be voting the proxies on all of those shares. That is not the case. We actually have a third party that we've hired. They have no political agenda. Their goal is to do what's in the shareholders' interest when they vote on those proxies for all those different positions that are held. Any questions? And I'm talking a lot. Does anybody have any questions?
I do not know what BlackRock is. Is
Oh,
it just a group?
It's like, have you heard of Vanguard?
Yes.
So Vanguard has a bunch of index funds.
Yeah.
We have a pretty good portion of our large cap equity in index funds. And there are 3 or 4 big providers out there. BlackRock is by far the cheapest, and they do a bunch of other accounting work and stuff for us too. So we're getting a hell of a deal from them.
They're also the biggest in the world. They're the largest asset manager on the planet. And I would just like to make one comment to add to this. Part of the reason that this system, the Board of Investments, has done so well over the years is because I was about to say it's emotion free, not quite. It's mostly emotionless. But unlike individual investors that are tempted to sell in panic and tempted to buy in greed, this is managed in a very non-emotional way.
Yeah.
So
It has been.
it's very good. It outperforms most individuals for that reason.
Like one point back on performance and such, we did a good job, I think, of raising cash and shorter term fixed income instruments in the first and second quarter. So we don't have any concerns about meeting any obligations or having to sell into this market. So they just, again, they do a really good job. I had some specific questions last time from Dee, and so I want to address those. I did get a chance to talk with everybody over there about these. There have been some changes in the benchmarks, and ideally, you would have your benchmarks and you would leave them alone for 100 years. You would never adjust them. But the reason why we've had some benchmarks change, the CIO before our current CIO, he came in and made some huge changes in what we define different asset classes as and how allocations fit together, and sort of carved up the different asset classes into smaller groups. And we're now in the process of moving sort of back where we were a little bit. We're backtracking on that a little bit. And so there are certain asset classes where the benchmark just didn't fit anymore. If we put a couple asset classes together, we couldn't use a specific high yield, bond fund index for something now that includes things other than that. So that's really the only reason. And prior to that, by the way, those benchmarks hadn't really changed for decades. And so I think going forward, the idea is that those benchmarks will stay. And it is good. I mean, it gives you something to compare to. You don't want to be messing around with those because it looks like you're trying to find one where you'll look better. That is not what's going on here. They just are trying to match the asset classes. It should be certainly more, it should stay the same from now on for a long, long time. The other question that Dee had was about the private assets. And I touched on those a little bit. I don't know how much time you guys allotted to me here, but I can kind of go through the headings of each of the different types. And if Dee, if you have some additional questions beyond that, maybe you and I could get together. But you were curious about, I can't really talk about it like a top 10 holding because we're really diversified. The list is legal size, 4 pages. So there's dozens and dozens of them. But in terms of the idea behind these things, there are a couple of private credit offerings where it's direct lending. So these are companies, not banks, they're private equity or private debt companies that lend directly to corporations. One of those is just sort of for higher quality companies. One of them is for distressed. So they would loan money to companies that are in trouble with the expectation that that company would survive and then prosper and be able to pay back at a higher rate. So we got a little bit of that globally, a little bit of that in North America. Large size, mid-size, and small size buyout. The main impetus there is that if you can buy a company at a lower multiple, and these companies do a really good job of consulting with management to try to move those companies into another echelon and actually increase their size and increase their revenues, that will give you the opportunity to then sell that company at a higher multiple. So it's not just that you're getting improved earnings, you're actually getting an improved multiple on those earnings. It's a really good strategy. And we use pretty small niche companies for that. Let's see. There's some insurance strategies. I think some of those are life insurance based. Venture capital is when you loan money to a brand new company. We've got a little bit of exposure there. And then we've got, in the real asset area, we've got energy companies. Core would consist of companies that own real estate properties that are fully leased out. Everything's good, and you earn a pretty low return for those. You know, you might earn 6% a year. There's Core Plus, and then there's opportunistic. The Core Plus includes a little bit of this opportunistic side, but a fully opportunistic fund would be one where you're going to buy into raw land, and there's a company that's going to go through all the permitting process. They're going to build a structure. They're going to hire managers. They're going to lease it out. Once it's fully leased, then they sell it to the folks in the core. And the internal rate of return on a project like that is about 13%. So you make about double the money on those projects. There's more risk, but you make more money on them. So we've got some of those too. Yeah, I mean, that's kind of the gist of it. And so dozens of companies that are doing those sorts of things for us. We have a pretty big percentage in those types of assets, and the returns have been fantastic. The returns have been above equity market returns. The volatility looks like it's less. Again, that's partially because they're not priced every 2 seconds like equities are. They're priced once a year or once a quarter. So they do feel a little bit more stable. And really, if things smooth out in these dips, they kind of are a little bit more stable. They are illiquid. So as I mentioned earlier, you can't really rebalance in and out of them really quickly. You buy into these things and you're locked in. But I think it's worth it for us. That's why we can have that 7+% expectation.
They're also the last place we'd need to go for cash. So the illiquidity doesn't bother us.
Yeah, right. We've got plenty of cash.
Let me ask you this question. What percentage of those private equity assets, you probably don't know this off the top of your head, but roughly are located in Montana? And is there any political mandate to try to look for opportunities here that's a bit more aggressive or above and beyond where we'd look outside of the state?
I would say that number is very close to zero.
Okay.
Yeah, and I just think it's about availability.
Yeah.
The types of projects that we're talking about here, just maybe there's a little bit in Bozeman, but in terms of having the scale to be able to do that, Montana just really isn't the place. It's usually in the much larger metropolitan areas.
Yeah.
I don't think there's any, I mean, again, our fiduciary responsibility is to make the most money for these plans that we possibly can. And so saying, oh, you can only do that in Montana would be really detrimental.
Oh, I wouldn't think that saying only would be appropriate.
Or even
Where possible.
Yeah, maybe, yeah.
And there are statutes that say we should be looking at Montana opportunities for those kinds of investments that apply to the BOI.
You know, on
But
the other side.
If
of
they're
it,
not available, they're not available.
So that, and this is unrelated, I guess, to us and our money, because our money's in cap, but there's all sorts of lending programs, there's down payment assistance, there's all sorts of things they do to help Montana businesses, lots.
Right.
And that comes with a mandate from the governor's office. And my concern there was, well, are we gonna make any money on those? And if so, when we report, can we put a little caveat and say, yeah, we would have made more, but we were required to lend this money at zero, because that's what they told us we had to do. None of that applies to us. My concern was, is there anything related to us where there's this government mandate to do something away from market? There isn't. None of that applies to us.
Thank you.
Sure.
Dee, did that answer your questions?
Actually, thank you. Dan, I appreciate that explanation. And I think just like you just said, that there are some things that are in the works for change, until we continue asking the hard questions, everything continues on the same continuum. So I'm glad that my questions were answered, but also that we continue asking questions and questioning our investments. And I think that's not only from the Board of Investments perspective, but from our retirement systems. We just need to keep on asking. Thank you.
Thank you. And thank you, Dan. So financial statements, Nolan.
Chair, members of the board, I'm on page 23, and these financials and budget are as of August 31st, so only 2 months really into the fiscal year, so this will be extremely brief. You have the comparative financials, of course, with August 31st of 2021. So as you go down the list, there's really, I mean, comparatively speaking to last year, our total investments are down. Of course, we had an extremely strong year that was kind of tapering off about that time, about August of 2021. So, you know, I expect, you know, that's going to be, we had negative returns in fiscal year 22, which just ended. And so, you know, we won't catch up really to where we were, you know, right away, but I do expect us to eventually. Really not much difference, you know, if you kind of look year over year in any of our assets other than investments. There is the intangible right to use the building. That was the GASB 87 statement that was implemented for fiscal year 2022 financial statements, and you'll see that going forward, but it had not been implemented yet as of August 31st of 21. So you'll see the intangible right to use the building, and that will be amortized over the life of our lease, which is, it was a 19-year lease when we signed it, but I think it ends in the end of the fiscal year of 2038, if I remember right. So, and then you'll see that below in the liabilities, you'll see the standard lease as kind of the offsetting liability. And the one big number that kind of jumps out at you here is that uncleared collections of 33 million. Well, that's just a timing issue with Board of Investments and how they, you know, at the end of every month, they sell assets, some assets, for us to make our benefit payments each month, and those go into a clearing account, and then they hit our cash, you know. So in this particular instance, it just happened to be by that very last day of the month, they hadn't cleared that collection account into our cash yet. So that's really all you're seeing there. Really nothing else on the balance sheet unless anyone has any questions or comments. Page 24, the fund balance statement, you can see, you know, as compared to this point last year, we actually do have, you know, significantly more investment revenue. Contributions are roughly the same, and same with benefit payments. The withdrawals, I do expect, you know, they're quite a bit less this year than they were last year, and I do expect that trend to continue. If you all remember, we had a project, kind of internal project, where we, you know, started sending out dormant letters to all of our non-vested membership, just letting them know that, you know, we haven't received contributions for more than 7 years, and they can withdraw their funds. And so that was prompted a large push for people to withdraw those funds that were non-vested. So over the last year and a half, there have been more withdrawals than usual, and now they're obviously starting to taper off. We actually send out those letters on a monthly basis at the beginning of the month, but they only include, you know, people from that last year versus several years that we were playing catch up on before. So so you can see, I guess, revenue over expenses as of August 31st is, you know, significantly better than it was last year, but we still aren't to, you know, that fund balance because of the returns. And again, these were as of August 31st. You know, this last month, the market probably didn't do as well. Is that right, in September? as it was.
It's a low last week.
I think I have.
September was under.
Yeah, September was a rough month.
That's the technical term.
Yeah, so those are not reflected necessarily in these, but you know, it's still, I think, you know, we're obviously in the black, I believe still, so.
No, and let me ask you a quick question. This is a minor thing, just for my clarification.
Sure.
When Kavanaugh and McDonald was up here earlier, they said that our total liability for the pension plan over the course of a year is about 800 million. Is that correct? Total expenses?
The 800 million was covered payroll.
Oh, covered payroll.
Yeah,
Okay.
they mentioned that our
Okay.
unfunded liability is about 1.7 billion.
Yeah.
Yeah.
But I mean, on an annual basis, what is what are all the retirement benefits?
They're a little over 400 million.
Okay.
430
Okay.
million.
That explains why, okay.
Right, and then we have, of
Total
course, our administrative expenses, but you know, those are more like 2 million. I mean, they're just a small, very small portion of that
Got it.
compared to the 400 million in benefits.
I'm clear now.
So, was there any questions on the fund balance statement? You can see that on the next page is kind of where those investment revenue totals come from, and the majority of it was in investment appreciation, you know, at least as of August 31st. I'm sure that number is not that high as of September 30th, but. And then, of course, there's below that is sort of our administrative expenses, which are very much on par with what we saw last year. I mean, they're not off by much. So, any questions on the financials? So the operating budget status, these are, you know, obviously extremely hard to project, only 2 months into the fiscal year, kind of using what we've already expensed so far in the fiscal year to project those. And only 2 months in, you haven't spent really enough to get a good picture. But I do anticipate our personal services. We've had, you know, several vacancies that were kind of unanticipated. So I do anticipate you know, somewhere between $50,000 and $100,000 surplus at the end of the year, you know, in personal services. And then the operating budget, I definitely don't expect it to be that high, the 287 as a surplus, but you know, it's probably, you know, somewhere in the $100,000 to $200,000 range of a surplus projected. And it's just not really reflecting some of those expenses so far. So page 27 is just our contracted services, which is our largest expenditure category. It kind of breaks it down by, you know, consulting and professional services and the various categories. And you kind of see where we're at and what we've spent so far in some of those budget categories. And we just had a couple delinquent agencies, and I think, you know, as of yesterday, all of those have actually submitted their reports, since I, you know, obviously did this quite a while ago, but those reports are all submitted, and there is no delinquent agencies that I know of as of now. So. And that's all I have. Unless there's any questions.
Any questions for Nolan?
Thank you.
Thank you very much, Nolan. Denise, would you like to talk about the Napa conference?
Sure.
Oh, wait a second. I'm gonna give, oh no, we're fine. Never mind. I was thinking I needed to do public comment, but not yet.
Madam Chair, members of the board, like all of you, it seems like it's been so long since I went to the conference. These seem like distant memories, but so I'll just quickly go through some of the things that were discussed at the Napa conference. This was the first time back live and in person because of COVID. So one of the first conversations was about diversity and equity and how corporations and pension plans and governmental entities and that sort of thing are dealing with in sort of the new world of not just the, non-discrimination, the long-term sort of notion, non-discrimination, but the gender identity issues that are now sort of in the front of everybody's mind as well. There are some pension plans that have implemented some pretty dramatic diversity and equity and inclusion programs. They've put a lot of effort and resources into it. Certainly, I don't see that happening here, largely because Montana's statutes on non-discrimination and that sort of thing have included some of these issues as protected classes longer than other plans have had to sort of deal with them. But of course, some of them are also philosophical and cultural issues. It's kind of interesting because we have English teachers among us. One of the things that you will see is that Darla and I had both sort of been hung up on the notion of his, her, rather than they or their, when you're talking about a single individual or that sort of thing. So for the English teachers among us, you will see more of our documentation and correspondence and things like that coming out, referring to they and their, where we're talking about an individual, just because that is becoming the new norm. Not grammatically correct, maybe still by some people's estimates, but that's about the only effort we're making at this time, really, with respect to changing for gender identity issue. Excuse me. There were discussions about fiduciary.
Denise, if I can just stop you for just a second.
Go ahead.
Sorry. I just had a question about that. So is that just, was that mandated by anybody, or is this just going to become like best practice for you guys when making those references to those pronouns and whatnot? Or is this, I mean, I'm just curious on what authority there is on.
It is definitely not mandated, but we have actually had member inquiries about places where we require that they tell us sex or gender of an individual. And of course, for some purposes, we have to know that, gender assigned at birth for actuarial purposes, et cetera. But with respect to just our general communications and that, it's just sort of a best practice to make it as generally applicable as possible and avoid offending people or generating phone calls that ask the question.
Right. I guess, yeah. And I guess for the actuarial purposes and such, I just wonder if that's actually going to muddle some of that and make some of those assumptions and some of that outlook a little bit more difficult in the effort to, obviously not offend people, but just for the technicality and the practices of what we do and what the whole purpose is. If the whole, changing the language that we use for our standards. I'm just curious because that's just very interesting that's
well, and yeah, we definitely are having to sort of draw lines or, certainly contemplate about the reason for our asking for that information, say on our beneficiary designation forms, et cetera, and whether or not, but it may be something that we have to address in greater detail going forward. Right now, like I said, we've had some inquiries, we've had some complaints. Well, I've actually had more than the one, but yes, we don't anticipate great changes at this point. I just found it interesting that there are plans out there that are putting so much time and effort and money into making these changes.
Right. And I think the point on that is to change just the consideration, like you said, the time and money that some of these systems are putting into making those changes in order to accommodate, certain needs or desires of individuals, out of, you're talking, of course, upwards of, hundreds of thousands of people in these plans to change language and to change concepts on behalf of just, a handful of people. I think that's I think that eventually could put us in a very, I don't know, a very compromising situation. So I was just curious on how that was kind of developing.
Yeah.
Dee raised her hand.
Go ahead, Dee.
Thank you. I'm kind of with the other trustee. Anytime we start making things so politically correct for a very minority population, I think we are asking for more and more problems. And that's just a statement. You don't have to change anything, but I'm just saying we need to tread this very, very lightly and be very careful with this. Thank you.
Yeah, and we are not doing anything in other than, and frankly, you know, using the his/her or s/he to, you know, for grammatical reasons, frankly, is more difficult than just, I mean, a lot of people just use the they, their as the singular pronoun anyway. So it's not, I mean, it's a minor change, and frankly, it's just, you know, internal expedience purpose at this point. So I understand what you're saying, and we are not making drastic changes. We're certainly not implementing a whole scale revamp internally. So,
And if I can just piggyback off of Member Brown's comment there, I do think it would be even the small changes. I am hesitant even to just. It is just a little concerning to hear even just the small changes, even though again it's very few people. It's kind of concerning to make those small, I wouldn't say concessions, but just those small steps in that direction could eventually, as we've seen in other states and things, and not to get political, but I mean, for the basis of our responsibility of what we have to do to make those small, and I think it even goes beyond just grammatical tense as well. I would just caution hesitancy to concede even just a little bit onto those things, just even out of the consideration of, you know, personal feelings. You know, again, like we talked about earlier, the whole investment concept is emotionless, right? This whole concept of what we're doing here is we're protecting members, and, you know, sometimes that has to supersede, you know, maybe what personal issues or personal considerations someone might have, because it's for the betterment of the system as a whole. I would just be cautious against even making small changes and using those tenses. That's all.
And I guess I would piggyback on that just by saying, I don't think it's a big deal at all. So I'll just put up my 2 cents there.
So the only thing, I guess, that where I would be a little bit worried about it, but ultimately we end up getting it, is before we ever pay a benefit, we get a copy of a birth certificate. Now, whether that means anything 100% of the time going forward or not is out of our hands, but we do require a birth certificate prior to paying a benefit. And it does matter actuarially, but obviously in Montana, I don't think we're gonna have so many changes there to where it will have any impact at all actuarially from the financial standpoint.
Yeah. There's no change in any benefit payments based on gender. It's only in our actuarial calculations.
Correct. It's what's sort of cooked in, you know, to the assumptions, and, you know, how for mortality purposes and all those things. Right. Correct. The formula still comes out the same.
yeah, we've had a couple of member name changes because they've changed their gender identity. You know, those kinds of things, but it just has not been a huge issue for us. So, I'm sorry, are we ready to?
Yes.
I'll power through the rest of these. So there were conversations just about the assumed rate of return since the Great Recession and the the number of public pension plans that have, like us, reduced their assumed rate of return. There was conversation about presentation about the new W4P, the new federal tax reporting form that applies for us in circumstances where we pay monthly benefits. We were lauded as one of the only 3 public pension plans known at the Napa conference to have fully implemented the requirement. And as you probably are all aware, Tammy then participated in a NCTR webinar discussing our implementation of the W4P process, and she did a spectacular job. It was a great presentation. There, of course, was discussion about security issues, and I'm just going to go very quickly through these if you have additional questions. The DOL, the Federal Department of Labor, has issued cybersecurity best practices for ERISA plans. Of course, we are not an ERISA plan, but as for a number of things, though it's not directly applicable to us, it may very well be sort of analogized as best practice standards that down the road could sort of be, asserted against us as the reasonable thing to do. There is also a new organization, I don't know how new, called the Sparks Institute. You may have heard in any of the conferences that you've attended. They're a non-regulatory working group focus on the security of pension plans. They've issued a framework of controls and objectives, including definitions of things like breach and fraud, preventing fraud in public pension plans is sort of their biggest objective at this point. They've put out some recommendations and some standards on management of contractors and vendors and ensuring that they are complying with adequate security features. The only thing from that perspective at this point, I mentioned before, all of our vendors who receive member information from us, potential identity theft information and that sort of thing. Their contracts include what we call a third-party agent agreement that holds them to essentially the same security standards and parameters that we would apply ourselves. They are also recommending, potentially audits for contractors and vendors. I will look at prior to the, May board meeting and renewal of contracts with some of those vendors at whether or not our TPAAs, our third-party agent agreements, need to be updated a little bit, but I think overall we're in very good shape on that point. So I think those were sort of the highlights. Any questions?
Wow, so thank you for the report.
Thank you.
Any questions? All right, then we'll move on to Darla. You went to the NCTR Customer Service Workshop.
Madam Chair, members of the board, I did speak with Sean at our last management team meeting about throwing in, not only talking about the NCTR conference, but the Montana Notary Conference that I attended just before that, because they do kind of relate and you're going to hear a theme here. So the notary conference, I am not a notary myself, but we had been talking about potentially doing remote notarization and other things on our strategic plan. And so I went on mostly a fact-finding mission, trying to get a sense of what goes on. So a notary conference, they have not had one since 2018. They only have it every 2 years. It was the biggest conference they never had. Great notaries, yeah. They love to have their conferences. But what I think what Denise already knew, and a lot of people knew, but I am new to this, is that Montana is truly a leader in the whole notary arena. This book is the Code of Professional Responsibility by the National Notary Association, and Lori Ham from the Secretary of State's office helped to write it. She is considered a guru, so they revere her. So it was interesting to talk with some of the speakers from other states and vendors. They all just think Lori is really great. So that was neat to learn about that. So I talked to a couple of the vendors. There are about, I don't know, 24 approved vendors that offer different flavors of technology, but only 2 of them primarily focus on public sector. So there's DocuSign and a company called Notarize. So I had talked to them again. At the time, we were thinking about remote notarization. There's different flavors of that, a lot of different ways you can do it, where people are signer and the notary they're both remote. Sometimes only the document is electronic, but people are in the room. There's all kinds of different permutations. But as you heard at the last meeting, for remote online notarization, which is known as RON, that is by far the most expensive and technology-based approach. And it's not what we need probably, so, as it turns out. So
When you say expensive and then you say not what we need.
right.
Yeah.
So a lot of these vendors focus on independent notaries or the mortgage industry or places like that, auto dealers, and where notarization of a buy-sell agreement, for example. So isn't really in our realm. So there's about 24 vendors that are approved by the state, most of those for independent notaries. So as our investigation continued, we realized that that's probably not what we need. At the time, however, when I went to this conference, we had been proceeding and are nearly done now, implementing the online withdrawal application. And in my TRS a few years ago, we had implemented multi-factor authentication, where to log in, you have to give a 6-digit code to your email or your phone number. And we were proceeding at the time as though that was adequate. So fast forward to the NCTR conference, and Denise mentioned it from her conference. John mentioned it at the last meeting about the conference he goes to. Security was all the talk. So at the customer service workshop, I'll just kind of give you a summary of what that was like. Of course, Sean went to the director's conference later that week, but the session I went to, there was communications people, mostly like my peers, as well as administrative assistants. They had a separate room. Robin Wheeler from CTR was facilitating theirs, and in our session we had Dean Kennerdine and Lee Snell. So that was a great conversation. They just threw out a topic, let us all discuss it. It was extremely positive. We were very engaged. I think they're surprised at how engaged we all were, but of course we're a self-selected group of representatives that wanted to be there and talk about how to do the job the best we could. And basically what I learned is, even though I was sitting next to the representative from South Dakota, and we were probably the two smallest plans in the room, we had Kansas, New York, Texas, California, Idaho, Nevada, and of course Georgia being the host. They were there. So what I learned, the thing that overwhelmed me was the amount of stuff we all have to do communication wise and outreach wise is the same. Even if I'm the only one here able to do it, some of the bigger plans might have had a staff of 10 that could do that. So it was interesting and useful for me to learn that the needs are basically the same, whether you're talking about outreach or implementing the W4B or whatever the topic was. We talked about all those things. And then a gentleman from Georgia PERS presented to us about some fraud that occurred with online withdrawal application. And I sat there and thought, oh no. So it was just a good, again, tying back to that notary conference, confirming identity is key. And multi-factor auth is probably not adequate. And like I said, you've heard that before. So we all have come back from our various conferences and realized that we really need to look at that. That's what we need, not remote notarization necessarily. We need to look at how do we identify that the person logging into our system or the person calling our office is who they say they are. So that's I know you've heard that before, but the two conferences that I went to kind of knitted that together in my mind, that's the issue. So that's what we're working on. I hope to be able to follow up with our members, because we had sent out that survey last year asking them what sort of things would they like to be able to do online. And we hope to achieve that, but we're going to need to do this first. And so I think that's just the responsibility we have to make sure we're not opening ourselves up to any sort of risk. So I think that was the biggest takeaway from both of those conferences from me. So any questions?
Did they by chance bring up, I read a report a couple weeks ago, DocuSign is working on technology to identify people through their iris.
I also saw that. They we're not going to be investing in this, but just as an example, their RON platform.
Mhm.
They already do, you can hold up your driver's license and it images it and compares it to, state database to make sure it's a legitimate federal, ID database. However they do that, they use knowledge-based authentication. But I think I saw something on their website about the iris.
Interesting.
Yeah, it's very high tech. It's very impressive. It just became clear that that's really not what we need. That would be overkill and not really not resolve our issues, which is making sure someone who logs in is really who they say they are. So,
Interesting.
yeah.
Our conference, that was a common thing as well. And that was, your comment about this is maybe the direction we're headed. My first thought was, oh my goodness. Should we be doing any of that at all? Because
Yeah.
it was relatively scary. And the other term that I learned for the first time was cybersecurity chief officers, and how many systems had them. Obviously, everybody has somebody that fills that role, but it was shocking how many of the systems actually have multiple staff members.
Dee has her hand raised again, so Dee, go ahead.
Thank you. Darla, when you said the phrase Montana is a leader, my smile on my face got very big. I think we got to take them when we hear something like that. But I think when you talk about communication and outreach and sitting around a table with very, very large groups, they might have bigger programs, but I don't think they have any better staff than what Sean and the rest have hired right here in Montana. So kudos to you and keep up the good work.
Thank you. I think we have a great staff as well. And it was nice to be at that conference. I have been in my job going on 6 years now, but that's the first one I attended. And I'm kind of glad I waited till I had been here a while, because I had the level of experience to be able to speak to all the issues they were talking about. It was mentioned that we were one of the first to implement the W4P, and people were like, oh my gosh, how did you guys do that? The communication must be terrible. Not really, we got it squared away. So thank you.
Thank you very much, Darla. Great, Sean.
All right, Madam Chair, members of the board, I'm going to give my verbal update on the directors meeting I attended in Atlanta as well. It was a few days after Darla's meeting there. And of course, the format of the NCTR directors meeting is a little different than most conferences. We spend probably 80% of the time doing roundtable discussions where each representative from each state will sort of update the group on pressing issues they're dealing with. And so it's really good because you find out that we're all pretty much usually always facing the same issues, and more often than not, we take a similar approach to trying to resolve those issues. And of course, the big thing for this conference was return to work provisions for retirees because of the teacher shortage. And then we did have a presentation given to us by Kavanaugh McDonald and GRS, where, and then a representative from, I think, from NEA, National Education, where they've ran the numbers, and the pipeline is there's not sufficient teachers in the current pipeline to solve the problem. They've already identified that's a math problem. They can figure that out. They're not there. So pretty much every state, I shouldn't say every, but most states are doing things similar to what we're proposing to do this next session, where they're loosening up for a limited period of time. It's not going to be wide open forever, but they're loosening up a little bit on their working retiree provisions to help sort of give a Band-Aid to the problem. Obviously, that doesn't fix new teachers coming into the profession and being long-term contributing members, but it will provide some short-term relief for employers. While some of the other folks in the like I said, one of the representatives was from the union. Their job is to try to to work with legislatures and various parties to increase starting teacher paid on the recruitment side. We don't really have a say in that. Obviously, that would help us. Todd told us this morning how, if you have increasing payroll, that actually helps because you have more contributions coming in sooner and we can make those investment earnings on them. So it's definitely a nationwide problem. It's not something unique to Montana. I think if you actually, I haven't seen any updated numbers on Montana, but a few years ago, I saw a report where Montana by itself actually does produce enough teachers to repopulate all the ones that have been, all the current retirees each year. However, we are a net exporter of those students because they can go out of state and make more money. And I'm sure Sarah Piper could probably speak to this better than I can as far as data on where those students are going. I guess the point is, as you well know, we have those provisions in our working retiree bill. They're certainly not as wide open as some states. There's some states have gone to where if you've been out for a year, you can come back and earn. There's no limit on what you can earn. And then other states are more similar to us, where you still have to have a break in service. And all of them, they were like, Georgia is the state where if you sit out for a year, you can come back and earn 100%. That's not forever. There's a sunset on that. And I think it's a short sunset. It's only like a 2-year, that's a 2-year provision. But they know that potentially can cause issues. You may have people retire for sure this year, knowing that next year they can come work. And essentially it's like having a drop program where you're going to get your full retirement and you can continue to work. There was one other state, I don't remember which one off the top of my head, but their provision was only effective for people that retired before a certain date. So that kind of drives, you wouldn't go retire this year because that date's already in the past, right? So they have that, but again, those are ones that you have to adjust almost every year or every other year in order for those to remain fair. There could be some discrimination claims on some of those kinds of things, but all in all, every state is dealing with the same thing we are. And so, that sort of helped me to get to the point where I could make the recommendations I did to the board for the working retiree provisions. Is that we're not alone. Everybody's going through it. Everybody recognizes those employers are our partner, and working retiree contributions are better than no contributions.
So if every state is doing this at the same time, that's less likely the IRS would come in and say, hey, this isn't a bona fide plan, you're not following.
I wouldn't guarantee that.
So we do still have our bona fide separation of service. The only, and even under 732, which is the provision where you can work full time, you have to have received at least 2 retirement benefits. So that means you've terminated employment. You went through that whole process. We verify that when you apply for retirement, and you've been out for a minimum of 61 days essentially in order to do that. So again, the IRS has never defined what a bona fide separation of service. They haven't put an actual this many days on it. So I think we would definitely argue that we still meet that requirement. Right?
Yeah,
Everybody's doing it.
well,
Exactly.
Yeah, however, 10 years ago, they implied that we probably weren't doing it.
Well, I think at that time you just had to attain retired member status, so it was 31 days.
well,
No,
but
No.
so the issue was, and it's very funny that you asked the question, because I was thinking of it driving to
that's how I
work
got
here
150.
this morning, was that at one point 10 years ago, there the definitions of normal retirement age were supposed to include some specifications on what constitute in-service distributions, and the guidance that the IRS was putting out strongly hinted that any post-retirement working program might constitute a prohibited in-service distribution. Those guidelines never, the promised regulations never came out. So yes, there is some sort of convergence of this need at this point to people's, well, all right, they never told us it was a problem and we have no choice but to make the change. So as Scott says, I'm not sure we're entirely in the clear, but it just is what it is.
And my fear is now we're talking about reinvesting into the IRS so that they can complete some of the tasks that they haven't been doing. Doing for the last 10 years, one of which is this.
Yeah. And it might be the flip that, oh gosh, everyone's doing it, we better clamp down on this, so it might make it worse. Yeah.
Yeah, so there's, yeah.
I'm inclined to think the IRS rules for public systems may not have ever come out because it became apparent to them that this is the norm in public systems, and it would be very difficult and very problematic for them to try to turn that train around for everybody. So I mean, but yes, all of those
But on the other hand,
concerns remain.
we've seen administrations from both sides of the aisle that don't seem to be afraid every once in a while to just stick their foot in their mouth and make radical changes overnight. So, who knows?
It occurs to me that it should be self-evident to everybody that, you know, part of the problem with the teacher shortage is just simply the overall level of pay, but that would be compounded so badly by some destruction of their defined benefit plan. And, you know, I don't know if that message is getting delivered.
I think it is, but I'll talk about that a little bit more.
Okay, when it gets to your turn.
When it gets to the trustee side, yeah.
He has her hand.
Yes.
Dee, go ahead.
Thank you. Director Graham, I'm wondering if in these roundtable discussions, as in the directors meeting, have you come away with some ideas perhaps that we could in Montana tweak a little bit of this or a little bit of that? Certainly we don't want to go erratic, but do you have any future plans for legislation?
So, Madam Chair and Member Brown, yes, I mean, that's ultimately what led to the sort of the final draft of our working retiree legislation for this upcoming session. I mean, and like I said, we are still fairly conservative compared to what some other states are doing. And I would not, I mean, I certainly would argue that if we pass those provisions, we still have at a minimum 2 months, you're out. We don't have any situations where somebody's terminating on Friday and they're coming back the following Monday and they're working. We do have a separation of service, and really it's defined what that is. So yeah, I ultimately, to answer your question, yes. I mean, that, like I think I said in my original discussion, it helped to kind of finalize for my own purposes, you know, what I thought should be our recommendation. And obviously you as the board are the ones that are actually going to set what that retiree bill looks like. But yes, that's the simple answer is yeah.
That answer your question, Dee?
Yes, thank you, Chair.
And then I guess just to sort of wrap up, I mean, the other real value of that meeting in particular is the networking piece. Like I said, we're sitting around, you know, essentially a big table, and you get to meet each of those directors from the other systems. You get to be, you know, become a first name basis with them. You have their contact information. And ultimately, if I need to reach out to someone over something that comes up, you've made that connection. So that's really one of the more valuable pieces of that meeting. And with that, I just thank the board for sending me. I think it always adds value, and this meeting was no exception.
All right, cool. Thank you.
Thank you.
And so Sarah and Scott also went to the trustee workshop. Sarah, I'll have you start if you don't mind. I'm glad to hear that it helped, but let's hear what you learned.
Yeah, thank you so much, Madam Chair, and everybody else there. Yeah, it was phenomenal. I think it was great timing for me, having been able to attend, of course, a few meetings after being appointed, and kind of having a little bit of familiarity. And then going, you know, to the workshop with, you know, folks across the country, getting exposure to how their systems work and getting more familiar with the technicalities of how the systems are supposed to function. Yeah, just overall, it was a fantastic experience. Really great networking opportunities, and meeting just different people there. The information was phenomenal. I mean, it was jam-packed. And there was no shortage of, it was like drinking out of a, fire hose again, just like this whole experience kind of has been, but gave me a lot of context, a lot more confidence in, being a trustee and a board member now. And yeah, it was great to meet all of those people and just get that exposure, and to be able to ask questions, and just get more familiar. And I was able to meet a couple folks, and they kind of recommended to me that I could potentially have, how do I put that? One of the other trustees, and she sits, I think, on the education committee, I think maybe with you, Scott, Amy Grant, had brought it to my attention that I might be a good fit on our education committee. And she did kind of say, don't take this the wrong way, but you're younger than a lot of the folks here, and so you might have some good ideas to bring to the table as far as NCTR goes, at the national level. So that was pretty encouraging. I did not take that the wrong way. I was like, that's cool. So that was really encouraging to hear that I kind of was able to fit in well with that group, and hopefully be able to provide more in the future. So yeah, just overall, it was fantastic.
Awesome. Thank you, Sarah. Glad to hear that. Scott?
I would agree with everything that Sarah said. The trustee workshop is a little bit different than the other workshops in that, we're kind of the part-timers that are trying to catch a lot of stuff when we come to meetings, or try to get understandings that we don't work with every day. So our workshops tend to be far more organized and thought out and topic driven than they are networking per se. But because the environment that we come to brings us all together for such a long period of time, we were there for 4 days, you really do make those networking connections as well. But let me just hit the topics that they talked on. It's a little surprising. We started off with fiduciary duties, then we hit into environmental, social, and governance investment factors, which, we don't necessarily get tied too much into the investment stuff, but having a little bit of an idea about what that is important. And we got into that pretty deep. We talked about cybersecurity on several fronts, both on a personal basis, but then also for the system. And we talked a little bit about that earlier. And some of the changes that are out there on the cybersecurity thing are scary. Alternative investments, I never thought I'd worry about that, ever. And it was intriguing to me to hear why those are important to other systems and why those investments work the way they do. I had never been around anything like that in my years here. And we had another session on the future of pension funds. And that was put on by the managing member of Coolwater, and also by the California State Teachers Retirement System. And obviously their take on things are entirely different than at least the things that I've been around in Montana. And so it was really interesting to see why they do some of the stuff that they do, and work on that. We spent some time working on a case study where we actually talked about some of the decisions that trustees and CIOs make in real life situations. Then we had, obviously had breakout sessions and some of those things. Lee Snell's federal relations update, I'm sure, is tied pretty much to everybody's workshops, and those are always informational and great. Then we also talked about ASOP number 4, which is setting the discount rate and communicating those cost obligations under law, which was really, obviously we do that every year, and we talk about those kinds of things, but the level of specificity that they got into some of that was phenomenal. And then Pension obligation bonds. Never thought I'd ever worry about pension obligation bonds. I'm glad to say we don't worry about pension obligation bonds because there are obviously some downsides to that. And there are several, 5 or 6 states right now that I've been thinking about ever since the conference because of what's happening in their obligation bonds and what that's going to mean to them. We spent a whole session just on the national teacher shortage. Todd was actually one of the presenters in that. But we got the take on it from the college side of things. We got the take on it from pension market leaders. We got the take on it from specific states that were having issues and why it's such a big deal to them right now. And that was good. And then another one that I never thought I'd really focus on much, there was a presentation on maximizing the handshake that DB and DC plans have. And I'd never really thought about that much at all. And of course, we do have access to a DC side of things in Montana with what we do. So it was interesting, the guy that said it right out of the chute was Matt Peterson, Executive Director for the National Association of Governmental Defined Contribution Administrators, said right out of the chute, we support and are only here to supplement defined benefit plans. You are our best customers. And I had never thought of it that way before. And then he went on to justify that and explain it. And it truly was for me, the light bulb kind of went on. That can be such a big part of that third leg of retirement, especially in those states that are struggling keeping up with benefits, and how those voluntary contribution programs could be real saviors for some systems.
Scott, was there any discussion in regard to that on the disconnect between the availability of those plans and the capacity for the school systems themselves to communicate that information adequately, properly, and consistently to their teachers?
Yes, there was, and also some discussion as to how important just the whole discussion is with the teaching world and the people that we work with. There were several trustee members there that had real concerns over where their pensions were at and the things that they had going on, and felt much better about. We need to go back to our members and talk about the value of having that financial advisor, the value of potential programs that are in each state or not in each state, and how that works, and of course investments overall and what that can mean to the individual teacher. It was the whole conference was excellent. Parts of it with the cyber stuff was really scary. They gave us a couple sites that we could actually go look at what people know about us individually. Made me rethink a whole lot of stuff. And the other thing that it really hit home on is how the fishing community, the people that are actually going out there and trying to hack, aren't really actually going out there trying to hack. They're actually trying to connect. They're connecting, they're talking to people, they're walking people through how they can open their computer up. They're doing some stuff that's just scary, just literally scary. And we see some of that in emails. We see some of that online where all of a sudden, we'll be looking at a web page and it'll come up and say, hey, you got a problem, call me. And they'll walk them right through. This is how we can help you, and this is what's going on, and please log into your bank and make sure that it works too, and we're connected and really trying to help you. And it's scarier than scary.
Yeah.
But it was a super conference, and I'm excited that Sarah, kind of got the invite to take a look at helping out with some of that stuff. We've got an education, I don't know where Sarah's at with it, but we've got an education meeting on Monday, the trustee meeting, to start setting stuff up for next year. And Berkeley, you know, it's a little bit different conference in that Berkeley actually treats us like we're students.
Yeah.
And for 2 days, they have us locked in. And this is what we do, and this is how we do it, and this is what we think you should think about and do. And then the third day is actually more driven by the members and the trustees themselves. But still, it was the longest day of all of them. But very good conference, very good stuff. And I would strongly encourage everybody to do it a couple times.
I know the trustee conferences are the ones I've gotten the most out of. I've enjoyed, I only did the main one
Manual.
once, but definitely the trustee conferences are great. All right, well, thank you all for your presentations. We have some tentative board meeting dates on the schedule. February 17th, May 5th, August 4th, October 6th, and December 1st of next year. We throw those out there so that we're aware, if you kind of put a little mark on your calendar, because some of those, like October 6th is usually one we cannot change, but the others, we have a little bit of leeway there. All right, so this is now a time for public comment. If you have any? See any right now?
Look like it, no?
All right, so then we'll move on to an action item to approve the out-of-state travel request for the executive director and 2 board members to attend the NCTR annual conference in Tucson, October 8th through the 12th. Funding for attendance was included in in our 2023 budget and already approved by the board in May. We were already done, and so it's already tomorrow.
So the budget is approved. Hopefully the board will vote to approve this because Dee's already in Tucson. Sarah and I have purchased our airline
Yes.
tickets.
We're glad you guys are going.
Denied.
Yeah.
Denied.
All right, can I?
This
I
is
think
supposed
Dee
to be
has her
big.
hand.
Okay, go ahead, Dee.
And I just want to say that Arizona's on standard time or a mountain time. They don't do daylight savings. So I was up really early.
On your well, not really vacation, but kind of.
Yes, thank you.
Thank you. Can I have a motion to approve the out-of-state travel?
So moved.
Seconded.
It's been moved and seconded. Any further discussion? All those in favor indicate by saying aye.
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 Chair votes aye as well. We're glad you're attending. I know my school would have killed me if I would have said I was going to go right now. So there we're at. Enjoy. And our next meeting date, if it works for everyone, December 2nd. We just want to make sure at least that one is on the books. Works for me. I'm assuming that that's good for everyone, so we will just move on from that, and that is getting us to a quick break. Let's see, we're just a little behind, so let's take about a break until 10:40. All right. We'll call the meeting back to order, and we will move on to the executive director's report.
All right, thank you, Madam Chair. So behind tab 5, I'll get it electronically here. Should have done that already. Is the executive director's report in your packet. I wanted to give the board an update on the remote office workspace initiative that has been underway. I touched on it briefly last meeting. So currently we have, well, we're in the process of getting back to having 20 out of our 22 FTE, those positions filled. When I wrote this, we were at 20 of the 22 being filled, but we obviously lost one, and I have an update on that here in a second. But of the 20 staff members we had working when I wrote this, we had 4 employees working remotely 1 day per week, 4 employees working remotely 2 days per week, and then we have 1 employee working remotely 3 days per week, and then the remaining 11 employees are working on site 5 days per week. So we worked closely as a management team group to sort of develop first of all, we got recommendations from Deloitte. It was a Deloitte study. We weren't necessarily tied to those recommendations. So then Tammy and I along with our supervisors, met with HR, and we came up with what we thought was manageable for TRS as far as the positions that were eligible for remote work. How many days did we think we could do that? And so we developed those guidelines, and then each supervisor met with their staff and figured out how we could still maintain coverage while offering some remote work. And it seems to be working just fine so far. I mean, all of our supervisors that have staff who are working remotely indicate that things are still getting done and on time, and the quality of work has not dropped off or anything. So that's the update. We have a little less than 50% of the staff doing 1 day or more of remote work. And it's kind of a personal preference. They're not forced to do any remote work. There's lots of the positions that were eligible to do it. They decided they didn't want to. So that's the update on that front. As far as positions go, so the first one there, when I wrote this, we had just filled, we hired Lydia, executive secretary named Lydia Vazdeva. And her first day was August 29th. And however, she's already accepted a different job back in the private sector. She came from Washington and was in the regional office of Costco and had some great experience. So she wasn't looking for work when she got this job. It was one she had already applied for before she left Washington and took the TRS job. And so we just couldn't compete with the offer. More than double their salary. So since then, we advertised that position for 2 weeks, and actually just yesterday offered that position to a new candidate that is going to start on October 17th, and her name is Desta Atkins. So she should be here for your next board member. So we were able to fill that one twice, essentially. The other 2 positions that we're still in the process of hiring for, one is a retired payroll specialist and the other is a retired payroll technician. And we've gone through a couple rounds of interviews on those positions. In fact, we're close to offering the position, I believe, or as of
For the
yesterday,
benefit
for the
tech.
benefit tech.
Yeah, just waiting on reference checks.
Yeah.
Yeah.
And then the other one, I think, closes again either the end of this week or next week.
Yeah.
So we've definitely been doing everything we can to fill those positions. We're advertising them. Sometimes we'll tweak the wording of the advertisement a little bit. And we've had interviews. We've had applicants each time, but just not anyone that, at least so far, other than, like I said, there's maybe an offer going out on the tech position here this week. Otherwise, the rest of the staffing has been stable, and those 2 have been vacant for a while. One of those vacancies was one of the retired payroll specialist position became vacant because we had a staff member take a higher level job as a benefit officer here at TRS. Any questions on either the remote work or the staffing? No? Okay, then the next item B is the legislative interim committee update, and I don't have a whole lot to share here other than just to let the board know. I did present our legislative concepts. They didn't review the full bill drafts, but I presented the concepts to the State Administration and Veterans Affairs Committee on August 11th for pre-session drafting authorization, and they did grant that. So once we get through our meeting today and I check all the boxes with the governor's office, I'll be able to send over our legislation, and legislative services division staff will be able to get started on those prior to the legislature starting. So that's always good. It's helpful to get those done. And then the other thing I did is I in statute, required to go present annually to the Education Interim Committee on the status of our reemployed working retiree statute, which is 19-2732. And I did do that already for the interim committee. And the report was, I guess, well received, is the best way to put it. I mean, they recognize that since they dropped the requirement from 30 years down to 27, you know, usage of that provision has gone up. That was expected. But it's only class 2 and class 3 school districts that are allowed to do it. So, and then finally, I will be presenting the results of the evaluation. Slideshow, it's almost the exact same slideshow as what Todd and Brian presented to the board this morning. I'll do that for SAB on October 26th. And then the LFC, they just haven't scheduled yet. I am required to go present it to the Legislative Finance Committee as well. I'm just not sure what date that will be. And then that's
The
my
actuarial
the
evaluation.
evaluation results. Yep. And then it's not an interim committee, but I will also, I'm required to go present those results to the Board of Investments as well. So I think in December, I will be at the BOI meeting to present those results.
Another, oh, I was gonna say another opportunity for public comment, but Dee, let's get you first.
Thank you. I just wanted to encourage board members who don't already know that the interim committees are live streamed, and Sean always does a good job on his presentation, but if you want to learn more, you can always tune in through the state's website.
Thank you.
I would concur Sean's presentation, that was good. And I appreciate that.
Yep.
Opportunity for public comment, but I'm not really seeing any public right now, so I think we'll move on. Now we're on to board legislation. And we're reviewing that and discussing our legislation.
All right, Madam Chair and members of the board, so behind tab 6 on your hard packet, and I'll pull it up electronically here. And on the electronic packet is the sort of high level write up of our board legislation, which may be easier to go through than the actual bill draft, especially on the housekeeping bill. And then behind this high level write up, starting on page 30, sorry, page 34, from that point forward, those are the actual bill drafts or statutes, the way that we would amend that. So I think maybe what I'll do is just stay on page 31 and go through the kind of the high level, what we're trying to accomplish. And then if anyone has any questions, or maybe it's a good time to just ask if there's questions before I dive into that, since you've had a chance to review it. No? Okay. All right, so the part 1, which would be amending 19-20-208 is new. This is not one that we talked about in August. And the reason that we're wanting to put this in there is now that we have an auditor on staff here at TRS, and we need to be able to request payroll records for all of their employees, not just the ones that they tell us are TRS members, in order to truly audit and make sure that they're reporting the people that they're supposed to. So we already kind of have, I would say, loosely speaking, we have that authority currently in statute. This would just make it very clear that we are authorized to request that information, and employers are required to provide it. Anything to add to that, Denise?
That's it. Exactly right.
Makes sense.
Yeah, it does.
So any questions on part 1? All right, then part 2, and again, this is potentially the most controversial part of the whole housekeeping bill, is adding in this more sort of restricted process for employers to call individuals independent contractors. We're not saying they can't do it, but if they do, this adds a few more hoops they have to jump through on their end to provide those assurances that they truly are an independent contractor. And this is, if you remember, during our last meeting, this was the one piece that Mr. Watson from SAM was, I wouldn't say he was opposed to it necessarily, but he said it caused them some concern. But we discussed that at some length last meeting, so I'll just leave it to the board to decide on that. Okay, no questions there. I'll move on to part 3. And again, this is one of the provisions that we already reviewed. This deals with direct transfers from PERS to TRS. And what it does is it eliminates the need to convert that PERS service credit to TRS service credit. And then PERS will have the corresponding language in their bill so that we're not trying to convert 9-month positions to 12 months and 12 months positions to 9 months, because it really, in some cases, really disadvantages the member. The second piece of that is making it clear that the actuarial, that we charge the actuarial rate of interest of that 7.3% instead of the 0.25% on redeposit of previously withdrawn contributions from the ascending plan. So someone that withdrew their contributions currently from PERS and they're going to redeposit those, so they're going to buy that time they withdrew from PERS in TRS, we allow for that. When this just clarifies, and TRS currently does charge the actuarial rate, the problem, PERS does not charge that, so they'll have corresponding language in their statute to fix that, because that's what they should be charged.
So if somebody just transfers straight across the board right now, that money goes, that
All of their money comes directly, so their contributions plus interest accrued comes directly. This part, when we talk about redeposited, they withdrew their money at some point in the past from PERS, but they're still eligible to purchase that time. But they have to pay all of the contributions and the interest out of pocket because it's no longer on account upstairs.
well, the question is, do we get any of that actuarial growth when they just come straight across from PERS?
Not exactly, it's in it, that works both ways, whether they're transferred from TRS to PERS or PERS to TRS. We get their contributions plus the interest that's accrued, and then we get 72% of whatever that amount is what comes from the employer side, and that's a direct transfer from PERS.
72%.
Yeah.
But-
And it works, it's that way, whether both ways, I guess.
Both directions.
Yeah.
And this change was implemented to address exactly that. Is now we get the actuarially assumed rate of interest for the full period of time that money was out of both systems essentially. So they have to pay the 7.3 for the amount of months, years, whatever, the money was not on account.
Right. And for
Which is
current law and current practice, when someone redeposits withdrawn funds just in TRS, so you're not talking about moving from one system to the other, but they withdrew a few years of TRS service and they redeposit it, we charge them that actuarial rate of interest. So there was just a scenario where they were getting a better deal by redepositing it in the other system than they would have if they just redeposited in the system that they were in to begin with. If that makes sense.
It does make sense, actually. I can see somebody thinking that.
I thought if you bought years, you were buying at the full actuarial cost based on your new salary and potential new benefits. Is that not how that works?
For a lot of the buybacks, we call them the service purchases options, that is exactly how it works. Like if you're going to purchase out-of-state service, those kinds of things. For a redeposit of service that actually was earned in a TRS position or earned in a PERS position, it's just the contribution amount plus the interest you took out on that day, plus additional interest from the day you took it out until you redeposit it. And so that interest we're charging is the actuarial rate of 7.3%.
Are there restrictions on timeframes or other things, or it's anytime you've taken that full withdrawal and then come back 10 years later, you're eligible to redeposit it? Anybody in time?
You are, yes.
Okay.
You're able to redeposit it. Strictly speaking about TRS, if you say you're a tier 1 member, you withdraw your funds and you come back anytime after July 113, you come back as a tier 2, but you are able to repurchase that service that you took out.
Okay.
All right, any other questions on part 3? If not, I'll move on to part 4. And what this does is clarify that the first 30 days or first 210 hours of service is only available to be purchased one time. You can't buy the first 210 hours of service for multiple years. It's a one-time thing.
Excuse me, Chairman.
Yes.
My screen isn't progressing. I only have 1, 2, and just a little bit of 3. Thank you so much.
He needed to, yeah, you bet.
Sorry, that's my fault. I'm talking instead of working the mouse here, but I will try to remember to do that. So we're on part 4 currently on this first 210 hours. Okay, if there are no questions on part 4, part 5 is the earned compensation and the 110% cap on earnings. And if you remember, this is one we discussed in August. We're not changing any of this language. We're just relocating it under a more appropriate section of code, so it's more obvious to our members. Because currently it's split up in the code, and I don't know that this will fix a whole lot of problems, other than it's certainly a lot easier to find if you're trying to find something on earned compensation. Any questions on that? Okay, seeing none. On part 6 of the housekeeping bill, this is the cleanup language that's necessary to remove the GABA statutes that we were never able to implement. And so with that, it would go retroactive back to July 1, 2013, because we never did reduce tier 1 GABA. And this clarifies that the floor for tier 2 is 0.5%. So there's no question. That's certainly what we've always said it is. That's what the legislative fiscal division said it was in their report following the session. But this language, PERS did the same cleanup last session on their statutes, because they were never able to do any different GABA for tier 1. And currently, if you read it, it would imply that we're only paying, some smaller percentage than the 1.5 for tier 1. All right, part 7, this was in the draft last time as well. This is use of the term physician in TRS disability statutes. Again, this satisfies what the House Bill 495 task force is trying to achieve, and rather than us TRS statutes be included in this massive bill that affects all state agencies, we asked to be removed from that bill, and we would clarify in our own laws use of the term physician. So nothing has changed on that. Part 8 is the renunciation of multiple $500 death benefit beneficiaries. Again, this is a situation where we might have multiple beneficiaries that are entitled to some portion of that $500 death benefit, and we, after some length of time has gone by, if we've only heard from 1 or 2 of the 3 or 4, then we're going to go ahead and pay that out rather than hold that money forever. And that concludes the 8 pieces of the housekeeping bill. So I guess I'll see if there's any questions or comments before we move on.
Anybody have any comments, questions, concerns?
Okay. Looks like Dee has her hand raised, maybe.
All right. Oh, I see you down at D. Yes, thank you.
Thank you, Chairman. Director Graham, have people from the SAVA committee stepped up? I mean, are there legislators already in line to carry our legislation through the next session, or are you waiting for it to be fully drafted?
Madam Chair and Member Brown, so great question. So Representative Bartolio has offered to carry both the housekeeping bill and the working retiree bill. And then Senator Lynch will carry, he's offered to carry the, I've reached out to him, but he offered to carry the university supplemental bill on our behalf.
Thank you.
Any other questions? All right, should we go on to the university supplemental?
All right, so members of the board, the only update to this is now we actually know what the number is, right? And it did come down a little bit. I believe this was 13.9% last session. And obviously you had the big gains, you know, because they do also receive credit for the actual, or the investment earnings. So you have the 2021 investment earnings that, you know, the 28% return mixed in with now the negative 4% return from this year, which results in it's actually slightly went down, even though now you have 2 less years to fully amortize this liability. That's the big challenge with this bill is July 1, 2033 doesn't ever move, and every session we get 2 years closer, so you have less time to actually pay it off. But those are the updated numbers from the university system valuation that Todd and Brian spoke to this morning.
Do you throw in that lump sum amount as well?
I put that on the fiscal note, yes. And that's such a small report that I actually, when I go to committee, I hand them a copy. It's only 4 pages. So I give them full report, and then the fiscal note reflects that 206 as a note, it reflects that $206 million as well.
Question, Madam Chair, that are we kind of getting to the point where it probably just makes more sense to change the law that takes away the 2033 deadline? And we just recognize that this is something we're gonna have to pay because we've already put out so much money to make it happen.
So, Madam Chair, and Scott, it's a good question. The thing about the July 1, 2033 date is it in and of itself, it does nothing. That's not a sunset date. The law will have to change in order for the contribution to either stop or to go up ever in the future. So if nothing ever changes, they'll continue to pay that 4.72%, even though it may be, you know, we may be in fiscal year 2040. At some point in the future, there's likely going to be legislation offered to do something besides our ask to increase.
Well, that's why I'm wondering if on a proactive basis, if we aren't getting close to a position to where it's just easier to justify getting rid of the sunset and stop the every 2-year edition of that bill. And just.
There is no sunset, right? It's just a calculation date.
Well, but it doesn't make any sense if it's in the law and whether it's sunset or not. It's 2040 and it's speaking to a 2033 date. That doesn't make any sense.
Trying to do backward math or something.
Yeah, I mean.
Do we keep it on, I'm sorry, do we keep it on the books to remind them that they still have this liability? Do we, I mean, we know.
So the impetus for having the report done is in the statute itself. It says that the TRS board will periodically recommend to the legislature the rate necessary to amortize by July 1, 2033. So we've always taken that to mean every session we update this number and we present it to the legislature. I actually don't think it's a bad idea to take a run at change. We could take a run at changing the law and say they're going to pay 4.72% until the system's 100% funded. And leave it at that, and then I don't know if it will pass, but we could.
Well,
but that's what it is without making that change. That's what it is.
That's essentially what it is until.
So why rock the boat? Because they might just say, "Oh, we're not going to pay it at all," or we are going to sunset at that day. We might end up with a change.
I can see. Well, I can see when we get closer to 2033, they're just going to say, "Well, it's over. We're already there. We didn't get there. We'll just accept that and." You're going to quit asking for it every time, and a decision is going to be made as to whether or not we keep the 4.72. And I'm just, you know, and I'm not saying we should do it this year at all, but I just wonder if we need to be proactive about addressing it, or even saying 2050. You know, making it a more reasonable time frame than 2033, because 2050 obviously is. Going to give us more realistic numbers, and it's also going to send the message that look, you're just not stepping up and paying for it. And
what was that
right now, teacher retirees are paying for it.
Do you know what that date was based on when they initially said it? Was that the fund? Was that
like
the amortization period?
It was
where we were at that time. Or?
Essentially, I mean, it was originally, I think it was supposed to be 10 years sooner. And so that university supplemental rate has gone under many different actuarial studies and sometimes dueling actuarial studies. The rate, early on, the rate, was set more often, just because, they would do this exercise and figure out that, oh no, we're charging too much or we're not charging enough. And it's a little contentious at the time. That's what, was projected that, that would be paid off. But since then, we've had multiple sets of new assumptions that we've utilized, right, through experience studies. And then you had your actual market gains or losses that get factored in since that time. And obviously the number is much different overall today than they thought it was going to be back in the early 90s.
Well, and I think part of it is, obviously any increase in budget for the university system is a big deal. So they're obviously not going to support that, but
those are all good points.
yeah. And I don't see that ever changing. So I'm almost wondering if changing the date or getting rid of the date doesn't make more sense than continuing to bring this up.
I can share with the committee that I was asked to come present to the university system benefits committee here about 3 weeks ago. And the whole point of that conversation from their perspective was to try to understand better what this supplemental contribution is and why they still have to pay it. See what happens is that, from their perspective, if they weren't paying that 472 to us, they would be putting that 4.72 into their defined contribution as an employer contribution. So there definitely would be some pressure from that side. The way we left that committee, I think they understood that it's their liability. It was the known liability at the time, and nothing prevents their employer from still increasing their contribution to their DC plan. But the 472 is really their commitment and what they're required to pay to TRS for their real unfunded liability.
Would it save us?
And
a little-
actually, that's worth, just knowing that is worth something.
Yeah, would it save us a little money and time if we did change that to whenever the plan is fully funded, you're done with these payments, and we wouldn't have to do this special report each time? Or is it good to keep reminding folks what's going on here?
So I would say it's been good to keep reminding them, because the last time it was adjusted was 2007. So it wasn't like when I first started here, it was 2013. It wasn't that long ago. But I think Scott's right. The closer we get to 2033, the less sense it makes, because we're never going to get a jump of 15%. The report itself is not that expensive. I want to say it's $6,000 every 2 years or $8,000 every 2 years. And I can tell you just based on our contract. But then the whole process, then we draft a bill. Obviously we find a sponsor for that. I go up and testify to the legislature. The best thing about that whole process is it reminds them this is what happens when you close a defined benefit plan to any kind of significant portion of your membership, that their liability doesn't just magically go away.
That's true.
I always do think that is a good reminder. That is our best example of anything we have when people think about
But
DB
in
versus DC.
2032, that's not going to have quite as much.
Right.
They're going to kind of overlook that part of it.
Right.
Anyway, that's just.
Yeah,
I
that's a
agree.
good point.
I agree.
Okay, so are there any other questions or comments about the university system supplemental bill? If not, I'll move on to our third and final agency bill, which is what we're calling our working retiree bill. And we didn't change anything except for adding a June 30th, 2029 sunset date to all three of these provisions. Both Member Doves and Member Brown indicated at the last meeting that they would like to see a sunset date on that, and Denise and I discussed it. We had no reason to disagree with that approach, so we we put a 6-year sunset, and the reason for that is that, just knowing kind of where things stand as far as the pipeline of teachers. I mean, even though, like I said, the last time I ever saw numbers on it, I think Montana does replace enough to take care of itself, but we end up exporting a lot of them. We thought of, I mean, that's totally up for discussion. We thought 6-year made sense, but the board might think something different.
No, I'm good with 6-year. I just think it's important for people to know that this is not a permanent thing, and that if it doesn't make sense to have it in 6 years, we're gonna get rid of it. And the sad part about most of the teacher candidates is the parts of Montana that really need the teacher candidates are not offering it, or have cut back so much. I'm primarily speaking of northern. They don't hardly have any candidates anymore, and pretty much cut out most of the programs. And it's that High Line area east that is just clamoring for people, and it's tough to get. It's tough to convince that candidate from Bozeman or even Eastern not to go to Wyoming, but come to the Highland.
Yeah. All right, Dee, I know you have a question. Go ahead.
Thank you, Chair. I really appreciate that we do put a sunset on these bills. As I stated previously, at every national workshop I've ever been to, the one mistake that we make in our retirement systems is that they go on forever without really looking at whether it's working or not. And so I think it will be a good time in 6 years that we'll either say, hey, this was a great idea, or, we need to change a direction a little bit. And I appreciate that we did that. Thank you.
Thank you, Dee.
That concludes my comments on the legislation, Madam Chair.
I guess my only comment on the working retiree bill, I support it. I feel like we need to help our constituents. I always get back to the thing, I don't like the retirement system funding teachers. I mean, that it's just, I don't know if I put that the correct way. And I also just feel like, I don't know. It just, the sunset has to occur. We have to look at this again. We can't just go on into perpetuity. And I also don't want to put a lot of pressure on retirees to have to come back to work.
Yeah.
Some people do get that pressure in those places. No comments. All right. Another opportunity for public comment. Seeing none, then we will move on to strategic planning.
Actually got it. I didn't see.
Oh, yes, we do. Sorry about that. We have to approve the TRS legislation for the 2023 session. Need a motion.
So moved.
Second.
It's been moved and seconded. Is there any further discussion about our legislation? Seeing none, all those in favor indicate by saying aye.
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 Chair votes aye as well. No nays. Okay, now we are on to the strategic planning. Sorry about that.
Okay, Madam Chair, members of the board, starting on page 64 through 66 is our strategic planning commitment worksheet that we look at every board meeting. I updated some of the things in red font that have either occurred or we talked about at the last meeting that weren't updated at that time. Otherwise, nothing has changed. So it probably makes more sense just to talk about those couple of things that haven't updated at this point. So the first one of those is on page 65, where we were talking about, we discussed this at our last meeting. Darla kind of touched on it briefly this morning when she talked about the notary conference she attended, but rather than look to get staff certified to do electronic notarization, it's looking like it's gonna make more sense to pay for a solution to that, whether that's truly a third party that's doing notarization or it's a third party that does identity verification. It may be more identity verification because it's important. I think that may, if we have really high confidence they are who they say they are and they're doing that process online, then there's really not necessarily a need to have the notarization piece. So at this point, we've deferred having staff do that training until we land on what that online verification is going to look like exactly. And we're looking at a few different solutions. DocuSign is one that's in the mix, and so is LexisNexis. And I think we'll be able to get a real robust system in place. We're just not exactly sure what that's going to be yet.
Excuse me, could you scroll up, please?
That'd be a change in policy.
Other way.
You want, sorry, oh yes, I see what you're saying. Right
Thank
here.
you.
Sorry,
Thank you.
Sorry about that.
Okay. That would be a change in policy, not anything statutory or anything else about when we get things notarized today.
Correct. So right now, we require notarization on a lot of our applications, like the retirement application being the big one, as well as we currently require that on a withdrawal, do we not?
Yeah.
As well as a withdrawal. And so we're in the process of we're getting fairly close to rolling out online withdrawals, and we're going to, for some period of time, still require them to print a piece of paper and have it notarized in the short term. Long term, we'll get that all 100% electronic. Yeah.
If I might, just really quickly, we can't force people to use online transactions. We will continue to have paper forms available, including applications that require notarization. It's not that we won't accept remotely notarized documents. We just won't train our internal staff to do them, because there are other people certified in the state to perform those functions. So.
All right, the next one, and I talked about this at our last meeting, was we did explore the ACH, requiring employers to use ACH, and we already discussed it. We actually can't, we found that under state law, we can't do that. So that is one that we're not going to be able to do, but we did deliver the recommendation to the board and at our August meeting that we can't follow through that. And then the final one, again, this was just a noting that it was completed at our August meeting, and that was researching working retiree options for potential legislation. And we did that today, obviously authorize that bill draft. Those are the only updates. I'm happy to answer the questions or discuss any of the other components of the strategic plan. If you want to take, if anyone has those.
Thanks for that.
Thank you.
All right.
And Tammy, we're on to application benefits. Oh, another time for public comment.
We don't have.
We don't have any public, so I'm gonna move on. We'll ask for it every time though. Regular survivorship adjustments.
Madam Chair, members of the board, the active and retired team, it was a busy summer as always. The write-up says 551 retirees, but it was actually 552 based upon the report that was generated by IT. From April 1st of 2022 through August 31st of 2022, and the average age was 61, a little over 61 years, and the average years of service was almost 24, with a average monthly benefit of $2,313.10 and term pay of $13,552.08. So busy summer as always. Any questions?
Did you see any COVID trend of more retirees, younger retirees, less length of service? Was there any trend at all noticeable in the data?
Personally, no.
Yeah.
The average is about the same as what
Okay.
we've seen for several years now. So
There's a lot of anecdotal discussion out there about that happening elsewhere, but
Yeah.
not for teachers. Huh?
Yeah. No.
Always an interesting list, especially this time of year, because there's so many.
Yes.
Yes, anytime. So Madam Chair, I'll just mention for Dee and Sarah both that we'll have this hard packet that we have available today. We'll keep those for you so you can look through this report. Otherwise, if you want to see the names on it, we could do that when we close the meeting. We just don't provide it in that electronic copy because you can kind of tell who they are and where they're from and how many years of service they had, all that stuff. So
I think, as far as I'm concerned, Director, I will look at it at the next meeting. You don't have to. I'm just interested in where in Montana the retirees are coming from. That's my main thing.
Does it really give us that, Dee? It gives us service, termination pay, their date retired, and their names.
Employer ID number.
yeah, the employer is a TRS ID number, so it's kind of hard to tell, where they are, but some of these, if you know what the employer number they are, the district is small enough that there's only gonna be one John Smith. And then you know exactly how much term pay they had and so forth. We do have, this isn't a perfect answer to your question, but we do have a map on our website that shows where all the benefit payments, where the retirees reside that are receiving benefits each year, and we update that annually.
Madam Chair, if I could, is this sort of average for the number of retirees? Is it going up, going down? Give us a little sense of that.
This is slightly higher than last year, but if you look at about a 5 or 10 year average, it's pretty close to right on what we've been doing the last 10 years.
Thank you.
It's pretty close.
All right. So now we're on to our legal counsel's report.
Madam Chair, members of the board, we have no, strictly speaking, legal issues pending right now, no contested cases, not even any at this point that might turn into contested cases, so unless you have questions, that's about it.
That's good news.
Yes.
Yes, it is.
Definitely.
All right, the next two items on our agenda are both action items. First off is the election of the chair and the vice chair, and then committee appointments to go after that. Do I have any interest in these things? Or
I nominate you.
me?
Good job.
All right. Does somebody else want to do this job? Really killing it to do it?
No,
Will you be the vice chair then? Or do you have time?
You know, I would, but I also think it might be time to work somebody into that.
Sarah, are you interested?
yes.
Oh, that's a big question.
What?
In the vice chair position,
Yes.
I would be pleased to be considered. I guess I'll put it that way. I feel a little pressure, but okay.
You don't have to feel pressure. See, what was I, about 30 years old when I started, and I think the second year they put me into those things too. So there you go.
Following in good footsteps then.
Oh, exactly. All right. Well, we need a motion then.
I would make a motion to have Carrie Elliott be our chair for next year and have Sarah Hitchcock be the
vice chair.
Second.
Okay, it's been moved and seconded. Any further discussion? All those in favor indicate by saying aye.
Aye.
Chair votes aye as well. Any opposed? Okay. And then we have our committee appointments. And they're set up right now as Dan and Dan at the budget and audit, legislation and litigation, Scott and Dee, and personnel and policy, myself and Sarah. Is there anybody interested in doing something different? But those seem to fit pretty well with all of our own interests and,
I was thinking I might like to move to legislation,
oh,
but I'm okay where I'm at too. If there's nobody who wants to swap.
I'll do whatever. So if you want to try it, I'll switch it.
And swap.
Sure.
all right, good. That's awesome because something different. All right. So our committee appointments will look a little bit different. Budget and audit would be Scott and Dan Chamberlain. And then our legislation and litigation would be Dan Trost and Dee Brown. And personnel and policy would still be Carrie Elliott and Sarah Hitchcock. We need a motion for that as well.
So
I'll move. Or I'll second.
All right, thank you. It's been moved and seconded. Any further discussion? Okay, all those in favor indicate by saying aye.
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 Votes aye as well. Motion passes. Okay. And now it is time to close the meeting based upon our disability applications. So let's take the disability request for Janelle Akers first. We need a motion.
I move that we disapprove the application for Janelle Akers.
I will second.
It's been moved and seconded. Is there any further discussion? Seeing none, all those in favor indicate by saying aye.
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 Votes aye as well. The disability request is disapproved. And then we will talk about the disability request for Sunny Bird. I need a motion.
I would make a motion to approve Sunny Bird's disability request.
Second.
It's been moved and seconded. Is there any further discussion? All those in favor indicate by saying aye.
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 Both sides. None opposed. All right. There is one more opportunity for public comment, and seeing that there is none, we will vote to adjourn or have a motion to adjourn.
So moved.
Second.
Moved and seconded. All those in favor indicate by saying aye.
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 Chair votes aye as well.